FTX, one of the largest exchanges, collapsed a few weeks ago. However, the news coverage is missing some of the key points. It's missing the fact that our entire financial system is based on the same practices that led to the collapse of FTX. In this video, I'm going to go through blow by blow exactly what happened at FTX and crucially how that links to what is happening in our current financial system today. What I'm going to cover is going to leave you angry, shocked, and probably quite horrified. Health warning, it is going to get technical, but bear with us because this is how they pull the wool over our eyes. They use this technical wizardry to bamboozle people. Don't worry, we will summarize it all at the end. Let's dive in. Step one, let's actually figure out where the customer money came in and where it went. So here we have the customer. The customer sends their money. In the early days, they would be sending their money to a company called Alameda, which was a sister company that was technically separate to FTX, but basically we found out is actually essentially the same company as FTX. And what Alameda were doing was they would send that money on, or so everyone thought, to FTX. And the reason why this arrangement was in place in the first place was because FTX at that time weren't able to accept deposits. They weren't able to accept that money, whereas Alameda were able to accept that money. And the thinking was that Alameda would buy US dollar-backed stablecoin and then transfer that over to FTX. Effectively, that would give FTX the money, and then they would then use that to be able to act as the money that the customers are using to be able to do their transactions. And so what happens on the FTX side is that these customers would be engaged in brokerage, and then they would be engaged in margin trading, and they would be engaged in leveraged crypto investments as well. And then the other thing that these guys were involved in is investing and trading in the gambling casino, otherwise known as derivatives. And this is things like options, futures, forwards, all of that good stuff that is the nuclear weapons of the financial industry, the thing that led to the collapse in the 2007-2008 global financial crisis. That's the stuff that we're talking about. And these guys were helping customers trade in this, and they were trading in this themselves. And this is the same stuff, by the way, that Alameda were trading in as well, and losing tons and tons of money. So let's take a step back and figure out how was FTX actually making money in the first place. So the way FTX was making money was the really vanilla stuff is that they would take a small fee for brokering the buying and selling of cryptocurrency. That's perfectly fine. Then what they were doing was they were lending to customers, and they would be taking collateral from the customers for that loan, and they would be loaning that money out and making interest. Of course, from a Sharia compliance perspective, big issues, but that's also a practice that happens. But then this is where it gets funky, because what this margin trading allowed them to do was sit on something called collateral. And they then use that collateral as their own collateral to take out further loans on the back of that. And this, ladies and gentlemen, is called rehypothecation. So let's park that over here. Rehypothecation. So let's assume that someone has £300 worth of cryptocurrency that they currently have on the FTX exchange. Now what they say is, can we actually borrow £200 more from you, dear FTX, and can you just effectively let us trade using that? FTX say, no problems, you pay us some interest, and now what FTX do is they take that collateral that has been posted by this trader, this £300 or so, and they effectively consider that as money that they can use for collateral themselves on taking out a bigger loan off the back of that and trading whatever they like using that. So this is what is called rehypothecation. So all of this customer money is now ending up as a collateral for loans that FTX has taken out to be able to do its own proprietary trading, which is just a fancy way of saying its own trading. And therein you have a major problem, because firstly, rehypothecation is just something that is going to add massive amounts of uncertainty as to who actually owns this collateral. Secondly, it enables massively leveraged bets, which means that if things go belly up, things really go belly up. And that's what rehypothecation allows. This is something that's massively frowned upon by regulators and people who understand this stuff generally. And this is something that is still practiced to this day in our financial system, not just in crypto, but in stocks and shares, in everything, in the property market, etc., etc. The other thing that FTX did, which was extremely naughty, was they mixed together the client money that came in because of brokerage and the client money that was sat in this margin trading, leverage, crypto investment space. Because people who were just buying and selling cryptocurrency, their expectation and their agreement with FTX and FTX's statements to them are that if we put in £100, then we are able to use that £100 to buy £100 worth of cryptocurrency. And you, FTX, are not going to touch that money. You're just going to look after it. You will make a brokerage fee from that transaction, but that is it. However, unfortunately, FTX did not do that. FTX just jumbled all of that money together into one big pot, and they didn't have any clue about what was going on. To be honest, that's what they're saying. I actually think they did have a really good idea what was going on, and they were doing this deliberately with a willful ignoring of their duties towards customers. And so all of this money that was just ordinary investors who hadn't agreed to any kind of collateral, high-risk type investment, all of this money was ending up in this rehypothecation bucket, which was then being leveraged up using loans, which then FTX were using to do further high-risk investments in derivatives. And this stuff, as we know, is highly toxic anyway. This is the stuff that if it goes fantastically well, will allow you to become the second largest crypto exchange in the world, but when it goes wrong, will end up bankrupting you within the space of a few weeks, as we just saw. Now, the other very naughty thing that was happening was over at Alameda. With all of this money that never made it across to FTX, Alameda were happily trading that, and quite badly trading it as well, it seems, because they were making some significant losses even during 2021, which was the height of the crypto boom. Really, if you're making losses at that point, then what on earth is going wrong there? So Alameda were trading away in derivatives. The other thing they had was a very cushy relationship with FTX, which meant that they didn't have any collateral requirement for margin investing. What that meant is that they could, so like most investors will need to post £100, £200 to be able to take out a larger loan against that and to be able to trade that, right? And if their investment fell by a certain amount, then their margin would be called and they would have to post up more margin in order to keep it safe, right? Now, what Alameda were doing is they had a good relationship with FTX, of course, because of their sister company. That meant they didn't have any margin requirement. So what that meant was they could always hold on for longer than everyone else in the downside scenario, which meant that they were always going to have an advantage against all of FTX's clients that were taking the other side of that particular transaction, which leads us on to how FTX, and by the way, how most of the financial sector, when it comes to this stuff, can make a lot of money by being a market maker. Because FTX was this big place where lots of people were transacting and exchanging, FTX would often take the other side of the transaction against a lot of its customers, which meant that in a situation where the customer loses out, it's a zero-sum game. Someone is going to win out, and that someone would be FTX. And this, again, by the way, guys, is something that we find prevalent across the entire financial system. Forex brokers are a classic example of this. They do this all day long, and 70-80% of their customers end up losing money and just handing it over to the exchange on the other side. Now, FTX had another trick up their sleeve. They had issued a coin called FTT, which was essentially its own token. Now, FTT was worth some money, but the bulk of FTT was owned by FTX and Alameda. And what this meant was if FTX wanted to print some more money, it would just pop into existence a bunch of FTT, and it would use this FTT as collateral for some of the loans that it received, and also it would accept FTT from Alameda as collateral for some of the loans that it gave to Alameda. But the problem is that if you are printing the FTT, and if you know deep down that actually what we're doing is a bit of a dodgy situation, then actually can you rely on that collateral to be worth anything? Or are you literally just giving money away to a sister company, that money that was the customers? And so what happened was, in total, Reuters, Bloomberg and others have reported that over $10 billion of customer money ultimately ended up at Alameda, completely unaccounted for, and then Alameda proceeded to then use those monies to invest and effectively gamble away. This is basically theft, and that's what was happening at this point. And that all was enabled by the ability to pop currency out of nothing into existence. So there are multiple Sharia compliance issues with this entire car crash. And by the way, guys, we have a crypto analysis table on our platform where you can see the Sharia screening for each crypto coin. And I looked up what we said about FTT many months ago, if not years ago, and we had said that this is something to be avoided absolutely at all costs, because it was getting involved in all of the dodgy stuff that we have already seen leading to catastrophe in the conventional finance space. So what was going on that was so problematic? Well, the very first thing is that you have derivatives involved. And whenever you have derivatives involved, Islamically, that's just a no-no. Why do we not like derivatives? Well, we don't like derivatives because you are typically buying and selling something that you do not own. A derivative is just a paper that says that I have some kind of right or some kind of linkage to some kind of other asset which I may or may not own at all. And what that allows you to do is therefore trade that thing without having to deal with any of that ownership risk or any of that ownership exposure. And then you can create derivatives over derivatives until eventually you're just playing with pieces of paper without any link to the real world or without any link to a real asset. And that causes massive risk issues because no one can actually figure out at this point, what do you actually own? What is going on? And this is what we saw in the global financial crisis as well, and we'll talk about that a little bit later on, and we're seeing it here as well. So that was issue number one. Issue number two, obviously, is loans, right? So that's an obvious no-no. Conventional finance-backed loans are not allowed under Islamic law. Then you've got issues such as margin trading. Again, this is an interest-bearing loan, so it's not allowed. Brokerage, technically, if you're brokering things that are not Sharia compliant, then that also can be most likely problematic as well. Leveraged crypto investments, that's another no-brainer, not allowed. Now, the theft of the $10 billion, what do you think Islam is going to say about that? Obviously, not allowed, and possibly attracting some very significant punishment, but we won't go there. And then you have this misrepresentation that is happening over here, which is that Alameda are saying that they've passed money on, and FTX are saying that we are one-to-one, we keep all of your money safe with us at all times, but actually neither of those things are true. And so there is people lying to you and then selling you something, selling you a service off the back of that. Again, that is complete misrepresentation, not allowed under Islamic law. The other thing that these guys were involved in is called insider trading. So these guys, they knew when a new cryptocurrency was going to launch, and they knew likely how it was going to perform as well. So what Alameda used to do, which by the way used to work out of the same Bahamas office as FTX, is take advantage of that insider information and buy up a bunch of that cryptocurrency beforehand and then dump it onto the market once the price had spiked after the launch, and made a killing using that technique. And then finally, on the Sharia compliance side of things, there are a number of other Sharia compliance considerations which we won't go into, but the final one that I wanted to call out is the price manipulation that these guys engaged in. When you are controlling the bulk of the supply of a particular cryptocurrency, that allows you to very artificially manipulate the price of FTT. What FTX and Alameda used to do was something called wash trading, where they buy and sell this cryptocurrency over a short period of time, and considering they own the damn exchange, they own the actual FTT token, and they can control how much of it is actually printed, they could then very, very accurately manipulate the price of FTT to be exactly what they wanted it to be. And that then allowed them to be able to get whatever loan that they wanted to get off the back of that. Because if they can set the collateral and they can make all of their balance sheets work, then they can get the loan that they want as well. So that was the other dodgy practice that they were involved in, which would not be allowed under the Sharia, or to be fair, also the conventional financial system. The other dodgy thing when it comes to margin trading and rehypothecation and all of this fancy stuff that was going on is that FTX were effectively often selling that debt that they had from the customer, and the selling and the buying of debt at less than par value, which is what would have been happening in this situation, can also be problematic from a Sharia compliance perspective. This was something that was completely par for the course for FTX in the day-to-day running of their business. And also, by the way, is completely par for the course for the mainstream financial system as well. So folks, we've seen so far how FTX was an absolute car crash, but the big story is just starting, because you see, FTX was just the tip of the iceberg, because the modern financial system as a whole has all of the same hallmarks, does all of the same practices that ultimately led to FTX collapsing. Let me explain. Many of you will have heard of this concept of a run on the bank. And ultimately, this is what happened with FTX as well. And FTX were really naughty because they should have had one-to-one coverage of all of their clients' money so that if it needed to be withdrawn, it could be withdrawn. But did you know that legally banks don't need to do that? So what is happening on the balance sheet of a bank? On one side, you have something called assets, and on the other side, you have something called liabilities. Now, liabilities include the deposits that you and I make into a bank, because what we're actually doing when we deposit money into a bank is we're lending to that bank that needs to then be paid out to us whenever we demand it. And so the liabilities make up a small portion. Let's call this deposits. Now, the way that a bank makes money is by issuing loans off the back of these deposits. Remember when we were talking about collateral, how you can use a little bit of collateral to take out a massive loan off the back of that? Well, this is what banks are legally allowed to do every single day of the year. And so banks will issue loans off the back of these deposits that can be a huge sum more. Any guesses? Kabzi, very real question for you. Kabzi is our videographer. How much deposits do you think are needed for a bank to issue £100 worth of loans? So let's say, a bank wants to issue a loan of £100. It needs to have a certain amount of money to cover that in its bank account. How much do you think that is?
1,000 quid?
No. Less.
400 quid?
Less.
100 quid?
Less.
10 quid?
Less.
5 quid?
You could just about get away with 5 quid, but it's actually around £8.5. So maximum for the most significant banks of the world that are really fundamental and structurally important for us, you probably need about £8.50 to be able to issue a loan of £100. Isn't that bonkers? And that is why, by the way, ladies and gentlemen, this entire thing is a game of confidence. And if the market loses confidence in the financial system, in the banking system, then the entire facade collapses. The entire thing goes up in smoke. So the first overlap is that banks can print money, just like FTX was doing with its FTT token. The banks print money by issuing loans, because when the bank issues a loan, that is the way that 97% of our money supply actually gets created. That loan that then ends up into the real economy. And then ultimately, that loan gets repaid back to the bank, but with interest. And the bank, it's a pretty sweet business. The bank just makes that interest off the back of this loan that it only needed to have £8.50 to be able to issue in the first place. How crazy is that? This whole activity is called fractional reserve banking. And that is a fancy way of saying you only need £8.50 to be able to give out a ton more in your loans. And this, by the way, is what people are complaining to about FTX. Isn't that massively hypocritical for regulators and everyone to be saying, oh, look, FTX, you screwed up because you weren't having enough coverage of your customers' money. Whereas the banking system, for heaven's sake, is exactly the same thing. And the only reason why the banking system doesn't collapse every time is because the governments and the wider financial system only allows maybe 1 or 2 banks to collapse maximum, like happened with Lehman Brothers back in 2007, 2008. But then after that, any other bank that collapsed, they rescued it. They made sure that it couldn't collapse any further. So let's have a think about now what actually causes these collapses each time. Well, let's have a look at some of those examples. You have the global financial crisis. What caused that? Well, what caused that was mortgage-backed securities that were wrapped up into derivatives and then sold on. So you have a house in the middle of America and you have a 100,000 loan on it. A bank gives that loan to this person. A bank then packages all of those loans up and sells it to Bank A over here. This Bank A over here has nothing to do now with that property, but it has these pieces of paper that it can use to package up even further, maybe add a bit more interest, a bit more leverage, a bit more financing on top, and then package it and sell it over to Bank over here. And this money has now got nothing to do with that property. So what happens at this point is that it's all hunky-dory, and all of this is leveraging up each time someone is taking a cut at each of these steps, and everything is going smoothly until the confidence goes from the market, until someone realizes that actually, heavens, no one is actually wearing any clothes through this entire chain. And this person who's been given this money really is not appropriate to be given this money. And as soon as that happens, the confidence evaporates and all of this stuff contracts up and implodes on itself. And suddenly you have massive gaps on the balance sheets of each of these banks. So the banks, they stop lending, and then the economy as a whole starts contracting, because at this point, if 97% of our money supply is linked to interest-bearing loans and private banks are in control of that and they stop issuing further debt, we have a crunch, ladies and gentlemen. And that is all because ultimately derivatives in the case of the global financial crisis. Let's have a look at another example. Let's have a look at pensions. The pensions crisis that was recently caused under the chancellorship of Kwasi Kwarteng. Ultimately, what was behind that was again derivatives that pensions were sold, and that became hugely out of whack, which meant that lots of margin calls were triggered, and ultimately the pensions had to sell off a number of their really high quality assets on the cheap that were hoovered up by the private equity funds all across the city of London. Derivatives was what caused that. So far we have seen that banks print money, we have fractional reserve banking, we also have derivatives, and rehypothecation, ladies and gentlemen, is also completely legal, and it's a massive phenomenon across the financial sector. You may not necessarily come across rehypothecation straight away, but did you know that your property, if you have an Islamic bank or a conventional bank, ultimately that stuff is getting securitized up into packets, and that's getting sold off to someone, and that ultimately is going to have leverage put on it regardless of what that ultimate asset is in the first place, and that is going to be ultimately using rehypothecation in some way, shape or form somewhere down the line. So rehypothecation is a core part of our financial system, and it's particularly prevalent when it comes to hedge funds and people who are trading on the stock exchange. So this still exists. And to be clear, ladies and gentlemen, printing money needs to be tightly controlled under Islamic law, and it certainly wouldn't be put into the hands of private banks who issue interest-bearing debt. Fractional reserve banking is again hugely problematic for the same reasons. Thirdly, you have rehypothecation. Again, the buying and selling of debt, the buying and selling of something that you don't own, the huge amounts of uncertainty that enters into these packaged, securitized and resecuritized transactions, hugely problematic. Derivatives, we've already said it, very, very problematic. The final thing I want to consider is regulatory capture. People are making fun of the fact that the Democrats and the Republicans took tens of millions of dollars in payment from people like Sam Bankman-Fried and the FTX exchange. However, no one is talking about how the financial sector has an iron grip over the regulation in the UK, the USA, and globally. The Federal Reserve, for heaven's sake, is partly owned by some of the private banks. It's a public-private partnership. It's very much a two-way street when it comes to setting economic policy. The government that we saw of Kwasi Kwarteng tried to do something radical away from the consensus of the financial sector, and the financial sector said, yeah, you try it, we don't agree with that. And now Rishi Sunak and Jeremy Hunt are towing the line and doing what the financial sector is a lot more comfortable with. Now, I'm not saying, by the way, that Kwasi Kwarteng was right, but what I am saying is the financial sector is hugely powerful, and it isn't just the case that the government sets the rules and is the big player, and then ultimately they have to fall in line and the financial sector does what it says. No, it's very much a two-way street, and the financial sector has a huge amount of power over how all of this stuff is run. Like, do you imagine that if we try to overturn this in the next few weeks and months, that the financial sector would be happy with this? Do you think that a bank that makes its money through this legal power to print money would just give that up? It's just not going to happen. And so this regulatory capture that Sam Bankman-Fried was trying to do in his unsophisticated way is actually something that the old school financial sector has achieved and most likely will continue to achieve unless something major changes. So folks, let's summarize all of this. We know that FTX were a bunch of crooks and that they messed up and lost money because of incompetence, because of lying, because of fraud. However, that is just the tip of the iceberg. Our entire financial system is based on the same principles and practices that ultimately led to FTX's demise. Our entire financial system has this concept of allowing the private sector to print money. Our financial system has this same concept of letting financial institutions play with their customers' money, using things like fractional reserve banking, using things like rehypothecation, using things like derivatives to be able to make an excessive return for themselves. And ultimately, if things go wrong, the customer is left holding the buck, or even worse, the government is left holding the buck. Folks, this entire game is a confidence game. And every so often, we see a glimpse of the mask when it slips, and we see what is behind it. And with what we are seeing at FTX, we are seeing an element of that right now. This video is, of course, a very strong critique of what happened at FTX and what is going on with our financial system. However, Islamic finance and economics is not just a critical system that throws bricks from the outside. There is genuinely an alternative to what we have described today. And in a future video, inshallah, I would like to outline what an Islamic financial system practically could look like that would deal with a lot of these underlying risks and a lot of this underlying unfairness that underpins our modern financial system. And really practically now, folks, to stay safe in your own investment journey, make sure that you never trade on margin, make sure that you never agree for your investment money with any broker to be traded on margin. Make sure that you don't engage in short selling, you don't engage in derivatives, you stay away from the haram stuff, and make sure that you try and stay within the regulated space as much as you possibly can do. Those are the basic things that you can do to stay safe. Until next time, Assalamu alaikum.